Thousands of dollars just disappear for creators every single year. Creator economy tax rules are a complex maze for many. Most content creators operate as sole proprietors. They are essentially their own small businesses. This means different tax obligations. One common mistake is not tracking all income streams. Many creators receive money from multiple platforms. Think YouTube AdSense, brand sponsorships, affiliate links, Patreon donations, and direct product sales. Each one contributes to their gross income. Ignoring even one source can lead to serious trouble. The IRS expects accurate reporting for every dollar earned. Missing just 1999 form can be a massive headache. Penalties can stack up quickly. Self-employment tax is another huge area of confusion. This tax covers Social Security and Medicare contributions. The current rate is 15.3%. This applies to net earnings from self-employment. Net earnings means your income minus your business expenses. For example, if a creator earns $60,000 gross and has $20,000 in deductions, their net earnings are $40,000. They pay 15.3% on that $40,000. This is $6,120 in self-employment tax alone. Many new creators are surprised by this significant sum. They might only budget for income tax. That is a costly error. Estimated tax payments are crucial. The government expects taxes to be paid as income is earned. Not just once a year at tax time, creators must pay estimated taxes quarterly. These payments are due on specific dates, generally April 15th, June 15th, September 15th, and January 15th of the following year. Failing to make these payments on time results in penalties. The penalty rate changes periodically, but it can easily add hundreds or thousands to a creator's tax bill. Keeping careful records is your best defense. Every single business expense should be documented. This includes receipts, invoices, and bank statements. Think about your equipment purchases. A new camera could cost $3,000. A microphone might be $500. Editing software subscriptions could total $600 annually. Web hosting might be $150 a year. These are all legitimate business deductions. They reduce your net earnings and therefore your self-employment tax. And your income tax, travel expenses related to content creation are also deductible. Attending industry conferences, for example, a flight might be $500. Hotel rooms could be $1,000 for a 3-day event. Per diem for meals is also an option. Even mileage driven for business purposes counts. Every mile driven at the standard mileage rate is a deduction. This rate changes yearly. For 2023, it was 65.5 cents per mile. Driving 2,000 miles for work could save you significant money. That is $1,310 in deductions. Home office deductions are often overlooked. Many creators work from a dedicated space in their home. If that space is used exclusively and regularly for business, then it qualifies. There are two methods. The simplified method allows $5 per square foot, up to 300 square feet. That means a maximum of $1,500. The regular method calculates actual expenses. This includes a portion of rent, utilities, internet, and homeowners insurance. It can be more complex, but it might offer a larger deduction. A creator with a 200 square foot home office using the simplified method gets $1,000 in deductions. This money adds up quickly. Understanding depreciation is also vital for larger assets. A new computer costing $4,000 is not fully expensed in 1 year. It is depreciated over several years. Or it can be fully expensed using Section 179 or bonus depreciation rules. These rules are complex. Professional advice often pays for itself. Ignoring these details leaves money on the table, or worse, leads to audit triggers. Form Schedule C is the backbone of creator taxes. This form reports income and expenses for sole proprietorships. Every creator operating as a freelancer files a Schedule C. It details gross receipts and then lists various expense categories. Advertising, utilities, office expenses, legal and professional services. These categories help organize deductions. Many platforms issue Form 1099-K. This form reports payment card and third-party network transactions. PayPal, Stripe, and other processors often send these. For 2023, the threshold for receiving 1099-K was $600. This means most active creators will get one. If you receive one, the IRS also receives a copy. This creates a direct link between your income and their records. Failing to report income from a 1099-K is a major red flag. Form 1099-NEC is for non-employee compensation. This is what brands pay creators for sponsorships. If a brand pays you over $600, they should send you a 1099-NEC. Again, the IRS gets a copy. This data matching is very powerful. It helps the IRS identify underreported income, many creators mistakenly believe that if they do not receive a 999 form, they do not have to report the income. This is completely false. All income must be reported regardless of whether a form is received. That is a common misunderstanding with serious penalties. State income taxes vary wildly. Some states have no state income tax at all. Florida, Texas, and Washington are examples. Others, like California, have high state income tax rates. A creator living in California could face marginal rates up to 13.3%. This is on top of federal taxes and self-employment taxes. Understanding your state's specific rules is critical. Some states also have sales tax obligations for digital products or services. If you sell ebooks, courses, or merchandise, you might need to collect and remit sales tax. This depends on your physical location and where your customers are located. Economic nexus rules dictate when you have a sales tax obligation in another state. This can be based on sales volume or transaction count. For example, selling $200,000 worth of courses into a specific state, or having 200 separate sales transactions into that state could create a sales tax obligation. This adds layers of complexity. Many creators simply ignore sales tax. This puts them at significant legal risk. Penalties for uncollected sales tax can be severe. International income adds another layer of complexity. If a creator receives payments from companies outside the United States or has international viewers, there can be withholding taxes. Some countries might withhold 30% of ad revenue. This is before it even reaches the creator. Tax treaties exist to mitigate this. Form W-8Ben is often used to claim treaty benefits. This reduces or eliminates withholding tax. Without proper forms on file, creators might lose a large portion of their international earnings. Hundreds of dollars could be lost unnecessarily. It is a common oversight. Retirement planning is often ignored by creators, but self-employed individuals have excellent options. A SEP IRA allows contributions up to 25% of net earnings, up to $69,000 for 2024. A solo 401k offers even more flexibility. You can contribute as both an employee and an employer. This could allow contributions up to $69,000. Plus, 25% of your net earnings as the employer contribution. These are powerful tax-advantaged ways to save. They also reduce your current taxable income. Saving $1,000 in a SEP IRA reduces your taxable income by $1,000. This directly lowers your tax bill. Health insurance premiums can also be deducted if you are self-employed and not eligible for an employer-sponsored plan. You can deduct the premiums paid for yourself, your spouse, and your dependents. This can be a substantial deduction. A family health insurance plan might cost $12,000 a year. Deducting this reduces taxable income. It is a major benefit for self-employed people. Failure to keep proper records makes all these deductions impossible. Imagine losing $5,000 in legitimate deductions. Just because you tossed out receipts, that is a $5,000 mistake. It means paying more tax than you should. The IRS has a 3-year statute of limitations for audits. They can go back 3 years. If they suspect significant underreporting or fraud, they can go back even further. Some audits are random, but many are triggered by discrepancies. Income reported by payment processors versus income reported on your Schedule C. A mismatch here is an immediate red flag. A creator claiming very high expenses compared to low income could also be flagged. These are not guarantees of an audit, but they increase the risk significantly. Professional help saves money and stress. A good tax professional specializing in small businesses or the creator economy can guide you through these rules. Their fees are also deductible business expenses, so it is a win-win. Hiring an accountant for $1,000 might save you $3,000 in taxes and penalties. That is a smart investment. Many creators think they can just figure it out themselves, but the tax code is incredibly complicated. It changes constantly. Tax laws are updated every year. Staying on top of every change is a full-time job. Most creators simply do not have the time or the expertise. They should focus on creating content, not deciphering tax jargon. Ignoring tax obligations can lead to significant penalties. These include failure to file penalties, failure to pay penalties, and accuracy-related penalties. The failure to file penalty is 5% of the unpaid taxes for each month or part of a month that a return is late. Up to 25% of your unpaid tax. The failure to pay penalty is 0.5% of the unpaid taxes. For each month or part of a month that taxes remain unpaid, also up to 25% if you owe $10,000 in taxes. And file 4 months late, your failure to file penalty alone could be $2,000 plus interest plus the failure to pay penalty. It accumulates rapidly. And imagine the stress of dealing with the IRS. That is something no creator wants. Maintaining proper documentation from day one is paramount. Set up a dedicated business bank account. Do not mix personal and business finances. This makes tracking income and expenses infinitely easier. For example, commingling funds means the IRS might disallow deductions or claim personal expenses as business ones. This could cost thousands in audit fees alone. Use accounting software like QuickBooks, Self-Employed, or Wave Accounting. These tools automate much of the record keeping. They can categorize transactions and generate reports. This saves hours of manual work. A creator might spend 5 hours a month sorting through transactions without software. With software, that time could be reduced to 1 hour. That is 4 hours saved. Every single month, over a year, that is 48 hours, almost an entire work week. That time can be spent creating more content or simply enjoying life. Remember that estimated tax payments are due even if you are not sure of your exact income. You should estimate conservatively and adjust later if needed. You can amend your estimated payments or pay extra if your income increases unexpectedly. It is always better to overpay slightly and get a refund than to underpay and face penalties. The IRS wants to avoid surprises, and so should you. The tax system rewards those who are organized and informed. It punishes those who are not. Understanding basis in assets is also important. If you sell a piece of equipment you use for your business, the profit or loss is taxable or deductible. For example, if you buy a camera for $3,000, depreciate $1,000, and then sell it for $2,500, you have a taxable gain of $500. This is because your adjusted basis was $2,000. $3,000 minus $1,000. This level of detail is important for accurate reporting. Many small details like this add up, leading to significant tax differences. Consider forming an LLC or S corporation. These structures offer legal liability protection. They can also offer tax advantages, especially when your income reaches higher levels. An LLC is often treated as a sole proprietorship for tax purposes by default, but you can elect for it to be taxed as an S corporation. With an S corporation, you can pay yourself a reasonable salary and then take remaining profits as distributions. Only the salary portion is subject to self-employment tax. This can save thousands of dollars on self-employment taxes. If a creator earns $100,000 in net profit, as a sole proprietor, they pay 15.3% on all 100,000. That is $15,300. As an S corporation, they might pay themselves a salary of $50,000 and take $50,000 as distributions. They pay self-employment tax only on the $50,000 salary. That is $7,650. A saving of $7,650. This is a substantial saving. It requires more paperwork and ongoing compliance. But the tax savings can be enormous. It is a strategy worth exploring with a qualified professional. This is a huge benefit for growing creators. These are the kinds of strategies that many creators simply do not know about. They just keep filing as a sole proprietor year after year, missing out on major savings. This is why education on tax rules is so incredibly valuable. It is not just about avoiding penalties. It is about optimizing your financial situation, maximizing your take-home pay, and building a sustainable business. Every creator deserves to understand these rules so they can make informed financial decisions. The future of their business depends on it. Tax season does not have to be a source of dread. With proper planning and knowledge, it can be a simple process, even a profitable one. Knowing your numbers is power. It protects your hard-earned money and allows you to reinvest in your craft or your future. It is about keeping what you earn and doing it legally without the stress of potential IRS letters or audit notices. The financial health of your creator business begins with understanding your tax obligations. It truly is that important.